Hi, let's start with the concept capsules. The topic that we're going to look at today is the factors affecting option values. You're going to see this topic as part of all the 3 levels of your CFA curriculum, plus you'll see this in FRM as well. So let's do a recap of the option notations as well as the basic option payoff profiles before we move on to how the factors actually affect the values. Now, there's 6 factors that impact the value of an option, and these are the same ones that we have done as part of option theory. Here, we're specifically going to look at the impact. So first, let's just look at all the notations again. S is your current stock price. Then we have X or K, which is basically your exercise price or strike price. You can use either of the notations. Then we have T, which is the time to expiration of the option. That we know that the options have a certain time to maturity. So how far along are we since the time the option has been issued? So time to expiration refers to just that this is the time which is remaining till maturity. Then we have R, which is basically your short-term risk-free rate over the period of time that you're calculating the value. And then we have D, which is the present value of the dividend of the underlying stock. So we can take it as dividend, or more generally, we can take it as any benefit, because it's not necessary that you would be dealing only with equity options. You might be dealing with fixed income options. You might be dealing with commodity options as well. Finally, we have the standard deviation, which is basically your expected volatility of the stock prices. So that's the same symbol that we've been always using. Now let's do a quick recap of what options are and what are the various option payoffs. Now, options essentially differ from forwards or futures in the sense that they are not an obligations for the purchaser. So anyone who buys an option is buying a right. So they can choose whether they want to use that right or not. It's completely up to them. So they'll only use it when it's profitable for them. Now, there are 2 different kinds of options that we have. We have a call option and a put option. Call option is for buying the underlying. Put option is for selling the underlying. Remember, we always think from the long's perspective, and then for the short, we simply reverse that. We simply do that into -1. So the 4 payoff positions that we have, the 4 option payoffs that we have are long call, short call, long put, and short put. Long call is the right to buy the underlying. So if you feel that the price of the underlying might go up in the future, then to hedge that risk, you would go in for a long call position. Now, the opposite of long call is short call. So one side is long call, that means the other side will be short call. So if long call is the right to buy the underlying, short call will be the obligation to sell the underlying. So because that's the person who's on the other side of long call. So remember, long positions have rights and short positions have obligations. Now for a put option, again the same thing, long put and short put. Remember, put is the right to sell from the long's perspective. So what is long put? That is the right to sell the underlying. So when do you go for this option position? When you expect the underlying to fall in value. So you want to hedge that risk. So that's why you go in for a long put position. Short put is the opposite side of long put. So if long is the right to sell, short put becomes the obligation to buy the underlying. So again, short does not have a right, short has an obligation. Now let's look at the formulas. Long call, the formula is max of 0 and ST minus K. So if the stock price was to go up, then this position is going to gain. How about a short call? You can simply multiply the payoff that you have for long call with -1. So you end up getting minimum of 0 and K minus ST. Now for long put, the formula is max of 0 and K minus ST. So here we have ST minus K for long call. For long put, it's a reverse. It's K minus ST. So we need to keep that in mind. Short put is -1 into long put. That means minimum of 0 and ST minus K. Now you have 2 different kind of options which are there, available in the market. Those are the American options and the European options. What's the difference between the American and the European options? American options gives you a lot more flexibility. You can exercise American options anytime till the maturity. Whereas European options are quite rigid. They can only be exercised at maturity. They cannot be exercised before that. Remember, we are saying that they cannot be exercised before maturity. That does not mean that they cannot be traded before maturity. The trading can still happen. It's just that the exercise can happen in the last day. So we always think from the long's perspective because it's the long who actually has the right. Shorts don't have a right, they have an obligation. Then we have the option premium, which is basically the price that you're paying to purchase that option. So long call is going to pay this premium and short call is going to receive the premium. Now let's go to the main topic, that is the factors affecting option values. Now this is the payoff that you have for the call position and this is the payoff that you have for the put position. These are the various variables that we are going to discuss. Remember, these are the 6 factors that affect the option values. Now, how are we going to interpret this table? On the left side, in the first column, you have all the variables that have been given, and you can see this mark. So the way we are going to look at this table is what will be the impact on the call values and the put values when these variables increase. So we're looking at the impact of the increase in these factors. Now you see 4 different columns here. You have small c, small p, capital C and capital P. Now what do these notations mean? The small c and p are for the European options, whereas the capital C and capital P are for the American options. Now the reason why the capital has been used is because generally speaking, the American options will be more expensive than the European options because they are giving you the added flexibility which European options don't give you. So they're giving you everything that the European options are giving, plus the option to exercise it anytime till maturity. So generally speaking, they will be more expensive than the European counterparts. All right. Now let's look at the first variable, that is S. That's the stock price. Now, how is an increase in stock price going to impact the call values and the put values? Now, S increasing. Let's simply go back to the formula that we have. Max of 0 ST minus K. If S was to go up, what will happen to the call values? Remember, this is the call option and this is the put option. If S was to go up, that means ST minus K, the spread between them is increasing. That means that the call option value should be increasing. That's what we have here. It's a positive here. Similarly, if S was to increase for a put option, what is going to happen? If S increases here, then you can see that the spread is actually narrowing because we have a negative in front of S. So the impact here is going to be the opposite of a call option. So call option was positive, this one is negative. You can see American options also have the same impact. So pretty much in all of these 6 factors, the impact is going to be the same on the European and the American options. There's just one exception, which we will have here. When we look at the European put option in terms of when we look at the impact of the time to maturity. So that's the only exception, but otherwise the impact on American and European is going to be the same. All right. Now moving on to the next factor, that is the strike price. Now what is the impact of an increase in the strike price? If strike price was to go up, then how does that impact the call value and the put value? Now again, let's do the same analysis here. If we were to, now we are not changing this, we are changing K. So if K was to increase, now K is negative for a call option here. So if this was to increase, that means your spread ST minus K is becoming narrower. That means the value is actually decreasing. Same thing here. If we were to increase K for a put option, you can see the spread is now actually increasing because K has a positive. So here that will be positive. So the stock price and the exercise price is going to have an opposite impact. So for a call option, this was having positive, whereas for K, that is going to have a negative impact. Now moving on to the next factor, that is T. That's the time to expiration. Now time to expiration, generally speaking, is when we increase the time to expiration, then the option value should go up. Now, how do we think about it? Now, without even going into the formula, if we just think about it logically, think of the option as providing you insurance, as providing you a hedge. If you were to take an insurance policy for 2 months versus 2 years, which one is going to be more expensive? Now, the 2 years policy is giving you more protection. It's protecting you for 2 years, whereas the other policy is protecting you for 2 months. So you're ready to pay more for that 2-year policy. So that's one way to look at it. Of course, we can go into the formula and we'll come to the same conclusion. But if you just want a quicker explanation, if you just want to remember this, then I think you can just remember it in this way. All right. So the more the time to expiration, the more the option is worth, because you have more chances of ending up in the money, of making money from that option. So that's why you see a positive in case of all the options. However, there is an exception here. When we talk about a European put option, the effect is actually unclear. Now, the reason why that happens is because specifically for a European put option, we will need to consider some more cases, such as a long-dated European put option. In that case, the effect could be mixed. In some cases, the price could go up. In the other cases, the prices could go down. The reason why that happens is because we have to further evaluate the volatility and the risk-free rate. So if the risk-free rate is too low and volatility is high, in that case, the value will actually go up. If it was the opposite, then the value would have gone down. So that's the reason why we've put a question mark, because it depends. There's no clear-cut answer only in this scenario. So that's for time to expiration. Next one is volatility. Now, how does volatility impact the price of all the options, or the value of all the options? Now, when you purchase any option, you've already had your worst case loss. You can't lose more than that because you've paid the option premium upfront. So it's not possible to lose more than that. Now, generally speaking, higher the risk, higher the return. That's what we say. But remember, the return could also go into the negative direction. However, if you have a long position on an option, you cannot go into the negative because you've already paid the option premium upfront. So you cannot lose more than that now. So the higher the volatility, the more chances of you ending up in the money from that option. Because in the worst case scenario, you will simply walk away and not exercise the option, so you won't lose any more money. So volatility is good for both European options, American options, whether it's call or put. It's good for everything. So that's why you always have plus sign here. So for volatility, it's always plus here. Then the next one is the risk-free rate. Now, risk-free rate, what is the impact of the risk-free rate? Now, of course, you can look at the present value and then calculate it, but I'll tell you an easier way to remember this relationship. Now, when we talk about the risk-free rate, especially for a call option, now, if you did not have the call option, how would you be hedging your risk? Let's say you're expecting a stock to go up in value. Without using an option, the other alternative would have been that you would have purchased that stock today itself, and then you would have kept it with yourself. So what did the call option actually allow you to do? The money that you would have spent today, that is something that you're spending after, let's say, 3 months, 6 months, or 1 year, whatever the option maturity is. So the call option has actually allowed you to defer that cash outflow which was supposed to happen today. So if the interest rates go up, you can actually earn a higher rate of return on the money that you've kept right now. Because you've not spent it right now, you have to spend it later, thanks to the call option. So it has allowed you to defer your cash outflow. So increase in interest rate is going to make the call option even more valuable. So that's why you see a positive here. Now, how about a put option? Now again, applying the same logic to a put option. Let's say you did not have a put option. What would you have done? You were afraid that the stock which you're carrying might fall down in value. So what you would have done was you would have sold that stock today itself and you would have received the money today. So if the rates were to go up, then you would have been able to earn a higher rate of return because you already had the cash. But because you went in for a put option, you did not sell the stock right now. You're going to sell it after again 3 months, 6 months, or a year. So you've deferred the cash inflow. Money you were supposed to receive today is now being received after a certain period of time. So if the rate was to go up, then you're actually losing money there. You could have earned a higher amount on the money that you had received earlier, but now you're not able to receive it right now. You have to wait for it for the next 3 months. So you're losing out on the additional return that you could have made for the next 3 months. So that's why this is negative. So that's the relationship for the risk-free rate. Now let's come to the last factor, and that is the dividend, specifically the present value of the dividend. We can generalize this to any benefit, not just a dividend. You can generalize it to, let's say, a coupon or, any other kind of benefit that you could be getting from a derivative. Now, how do we remember the impact of present value of dividend on option value? I'll tell you a very easy way of remembering this. Now, what do we do with any benefit when it comes to derivative pricing? Not just option pricing, but for any derivative, even for a forward or a future contract. We take that benefit and we take the present value of that benefit and we subtract it from the spot. That's what we do. That means that if we were looking at this call option, what would be the treatment of the present value of the dividend? We would have subtracted this from the spot. Now, if you were to do this, that basically becomes like this. So ST minus D. Now you see that minus D and minus K, of course, they're both moving in the same direction. This is negative and this one is negative as well. So they will be moving in the same direction. So you don't even need to go back to the formula. If you remember K, you can just use the same relationship for D because both have the same sign. So strike price, the relationship with call is negative. So even D becomes negative. Similarly, for the put option, the relationship of K is positive. So even this one is positive. So that's, I hope, an easy way for you to remember how to treat the dividends. Both have to be subtracted, so both move in the same direction. So the relationship is also going to be the same. Now let's try out a couple of questions to understand this better. That's your first example. Which of the following statements about long positions in put and call options is the most accurate? Now the profit from a long call position is directly related with the stock price, and profit from a long put position is inversely related with the stock price, or is the profit from long call inversely related with the stock price and profit from a long put position directly related, or are both of them directly related? Now we know that we are talking about a long call and a long put position, and we have to look at what is the relationship with the stock price. Stock price, remember, was S in the previous table that we saw. Now for a call option, when the stock price goes up, then the call option is going to gain. But when we talk about the put option, remember, it is K minus ST is the formula. So if ST was to go up, the put position will end up losing. So the call position will be directly related with the stock price because it's gaining. Put position is going to be inversely related. So your correct answer is A. So that's your answer. Now let's look at another example. Now the value of a European put option decreases with an increase in volatility and increase in discount rate, or it increases with an increase in volatility but decreases with an increase in discount rate, or does it increase with an increase in volatility and an increase in discount rate? So we are talking specifically about a European put option. Now, what is the relationship with volatility? Remember, volatility affects all the options in the same way. So if the volatility was to go up, the value of all the options is going to go up. So increases with an increase in volatility, that's a given. So we know that that's going to happen. So it should be either B or C. Let's look at the second part to see which one is the correct answer. But decreases with an increase in discount rate, or it increases with an increase in discount rate. Now we just saw what was the relationship. So remember, when we talk about the discounting rate, the risk-free rate here, if we look at a put option, if you have to analyze the relationship of the risk-free rate, with the put option, your cash inflow is getting deferred. The money that we could have received right now is being received after, let's say, 3 months. So it's going to have a negative relationship, not a positive relationship. So the correct answer will be that it increases with an increase in volatility, but decreases with an increase in discount rate. So the answer is B. So these were the 6 factors affecting the option prices.